Good morning and welcome to TaxCraft Ichiban's quarterly tax call, where we get to discuss the recent developments in the tax world as affects you, your business, and the world around you. My name is Salam Elera, Human Resource Officer at Ichiban Tax. I'm excited to see you back here for another session that is interactive and educative. Before I hand it over to my colleagues, let me introduce them to you. First, we have Robert Waruiro, who is our managing partner and tax lead. Then we have Luke Njeru, our tax manager, and Margaret Mutinga, tax and regulatory advisor. Now, before I hand over again the baton to them, please note that we'll have a Q&A session after their presentation. So I welcome you to put your questions into the chat and we'll get to them after. Also, my colleague Marcy is going to be uploading a link to a survey. Please take a moment to fill it out. We'd love to hear your thoughts. Without further ado, Luke, over to you.
Thank you very much, Salame. Yes, indeed, there has been so much development in this particular quarter, and we are happy to have you in this particular call to take you through the various developments. Allow me to take you through the discussion outline for today's call. We shall look at the various developments that have happened in this quarter, both locally and globally. We shall look at the Business Laws Amendment Bill. However, this bill hasn't been presented to the National Assembly, but we have had an insight about the various proposals in this bill that may affect our business. We shall look at the various case laws that have happened in this quarter. And lastly, we shall have a session where we shall be able to respond to your queries and the questions. So without any ado, allow me to take you through the various developments that have happened in this quarter. One has been on the changes at the KRA at the top management level, where we have seen the commissioner of the large and medium taxpayers, who was Madam Rispa Simiyu, being seconded from the KRA to the National Treasury, and our contract, which was expiring, has not been renewed by the Kenya Revenue Authority Board. So therefore, based on that, Doreen Bingi has been appointed as in an acting capacity for that position. Also, we have also seen that the various changes at the Taxpayers Services Office, which is commonly known as the TSO, whereby KRA has reshuffled various account managers and the debt managers, and therefore it's very important for each and one of us to be able to familiarize and see whether there is any changes that have happened that might affect our relationship managers with the Kenya Revenue Authority. We saw the National Treasury giving a guideline to the KRA in terms of the utilization of overpayment adjustment vouchers, and this relates to any overpayment of taxes that allows you to be able to set off against existing tax liability. So based on this guideline, we saw the National Treasury giving guidelines to KRA that these overpayment vouchers are only available for utilization against income tax and the value-added tax. And therefore, these overpayment vouchers are not available for utilization against agency taxes. And when we mean agency taxes, these are the pay-as-you-earn and the withholding tax. Another development is that we have seen is on the special table taxpayers who are registered for VAT obligation, and their VAT obligation has been suspended by the Kenya Revenue Authority, which means that you cannot be able to file your monthly VAT returns. So based on this, KRA has moved further in terms of ensuring that for those who are listed under the special table, they cannot be able also to issue their ETIMS invoice, which means now, in a compliance perspective from the KRA side, is that they want you to be able to engage them so that they can be able to verify your records, so that you can either one, have a payment plan, or you can agree on the settlement of the outstanding tax liabilities. We have seen Kenya Revenue Authority trying to also advance in terms of the various developments in the technology, and they are trying to embrace the artificial intelligence model, or AI, which is commonly known as the AI, whereby at the port of Mombasa, we have seen KRA install scanners that are AI enabled, And these scanners are able to identify or to verify the containers that are coming into Kenya and able to identify any illicit goods that are coming into Kenya. Further, through the end of the micro and the small taxpayers office, they have indicated in a way to be able to broaden the tax base in terms of ensuring that they are able to come up with an agency model. And in this agency model, they want to be able to reach out to the informal sectors so that they can be able to expand their tax revenue. And based on the even KRA's data, they say that there are 21 billion taxpayers who are registered, who have PINs. However, from these 21 million, it's only 9 million that are active in terms of the filing of the returns and the payment of taxes. So based on that, KRA wants to reach out to the remaining 14 million, and that's why they want to bring in agents who will be able to reach out to those informal sector. We have seen KRA provide a public notice on the Simplified PAYE, whereby effective 1st October 2025, any employer is required to file their PAYE return based on the Simplified PAYE return, which is available on on the KRA website. And also, we have also seen the various payroll providers have been able to advance their payroll system to be able to be compatible with the KRA's CSV file, which is compatible for filing of the PAYE return. In this quarter also, we have seen KRA issue a public notice on the gratuity exemption. To take you back, in July 2025, the Finance Act provided that any gratuity paid to an employee effective 1st July shall be exempt from pay as you earn. So in this public notice, KRA gave guidelines on how this particular exemption shall be applied, and therefore any gratuity that is earned from 1st July 2025 and going forward, that gratuity shall be exempt. However, any gratuity that is earned that is paid for the prior year, prior to July 2025, and paid in the year 2025, that particular gratuity shall be subjected to pay as you earn. So, this is in line with the provisions of Section 5 of the Income Tax Act, which subjects the gratuity to tax. So, in case any gratuity has been earned prior to July 2025, that gratuity shall be taxed. However, any gratuity that is accrued going forward from July 2025 shall be exempted from pay as you earn. We have also seen KRA issue a ruling on the carry forward of the tax losses, and the Finance Act 2025 amended Section 15(4) of the Income Tax Act, which provides that the carry forward of the tax losses has to be limited to a period of 5 years. So in this ruling, KRA mentioned that in this amendment of the Finance Act did not provide a transition clause for the treatment of the 2020 and the prior year tax losses, and therefore, by the reading of the law, any losses that arises or that have been carried forward for a period before 2020 shall be deemed not to be allowed for carry forward for corporation tax purposes. KRA has also issued regulations relating to the significant economic presence tax, and these regulations are able to, in line with the amendment that came through the Tax Laws Amendment Act in December 2024, which provided that any player or any non-resident who is earning income from Kenya, from the digital space, they are required to pay a CEPT. And therefore, based on these regulations, KRA is trying to be able to invite any players that have been affected by these particular changes to make any comments by the 7th October 2025. The Finance Act 2025 also amended a requirement of every import that is coming into Kenya has to have a certificate of export. And therefore, in effective 1st of October 2025, any consignment that is coming into Kenya is required to have a certificate of export. However, KRA has provided some of the exemptions that are not applicable for this provision. And one includes personal baggages, human remains, or goods imported by the privileged persons into Kenya. In this particular, also just to mention, we have also cited the double taxation treaty agreement, which has been signed between Kenya and Belgium, effective 30th September 2025. And in our next or subsequent TaxCraft, we'll be able to update you more on the various amendments or the various provisions that have been provided through that DTA agreement between Kenya and Belgium.
Morning.
So allow me to take you through the Business Laws Amendment Bill, the various proposals that have been proposed in this bill. One is on the VAT Act, to be able to limit the timeline for claiming the input VAT from the current 6 months to a period of 2 months. There is also a proposal to amend the Special Economic Zones Act and provide for educational zones. And in our view, this amendment or this proposal is based on a current case that is ongoing at the High Court between Nova International School and the Kenya Revenue Authority, where KRA, after verification of following a KRA audit on Nova International School, they noted that even if the school was established under the special economic zones, the school was not entitled to enjoy the tax benefits or the tax incentives that are provided under the special economic zones. We have also seen a proposal to amend the special economic zones to limit the license or to a validity of 10 years. Currently, there is no any validity in terms of the period that an operator can be able to run through or their operations under the special economic zones. Further, there is a proposal to amend the Stamp Duty Act and provide various exemptions for any instruments that are transferred to shareholders or internal reorganization. Also, instruments that are transferred to real investment trusts that are organized, that are authorized by the Capital Markets Authority for purposes of structuring shall be exempted from stamp duty. Under income tax, there is a proposal to exempt capital gains tax for any properties that are transferred to rates or any transfer to investee entity of a rate. Lastly, there is a proposal to amend the Miscellaneous Fees and Levies Act and provide for the definition of the raw materials, intermediate products, and the goods. And my colleague Maggie, under the recent case laws, shall give us an insights about the Alliance One Tobacco Kenya versus the Kenya Revenue Authority. Allow me to invite my colleague Robert to take us through other developments, both locally and globally. Over to you, Robert.
Thank you. Thank you very much, Luke, and good morning, everyone. So we'll quickly go to other developments. Next slide, please. And we'll start with the new integrated e-procurement system by the government of Kenya. Now, the whole idea, ladies and gentlemen, around this is trying to reduce the wastage. You'll remember that we are trying to do fiscal consolidation as a country, which means either we increase taxes or we reduce expenditure. And part of the opportunity that the government has seen is to reduce expenditure wastage, and that's the reason why we've got the EGP or electronic procurement platform by government. Next, we've also seen Revenue Authority, the Central Bank of Kenya, come up with the draft non-deposit taking regulations of 2025. And where this is coming from is the Tax Laws Amendment Act of 2024, which essentially increased Central Bank of Kenya's scope in terms of regulation just from digital credit providers to include also non-deposit taking non-deposit taking entities. And so those regulations are expected to be published anytime soon following the lapse of the public participation in September. We've also seen the Betting, Lotteries and Gaming Act 2025 coming into place. And really, the key thing around this is modernizing the regulatory landscape for this sector. And one of the things that we have seen is that there's now going to be a gaming regulatory board, which will replace the BCLB as we've known it. We've also seen quite a lot of controls around that sector in terms of advertising and so on. And it'll be interesting to see how this compares as with the old act as we continue implementing it. Then we have the developments regionally or globally. First is, if you look across Tanzania, we've seen the lowering of the VAT rate from 18% to 16%, and we're just awaiting regulations. Now, that's a good thing because in DRC as well, the VAT rate is 16%. So we probably can see the beginnings of a convergence of the VAT law, just the same way we have a convergence of the customs law under ICMA. And so this is probably something to continue watching. And probably for Kenya, we probably would want to implement the proposal in the medium-term revenue strategy to bring down the VAT rate to about 15%. Next, we have seen Nigeria delaying the implementation of its tax reform act. Remember, in 2025, Nigeria had a host of laws that came through, which were supposed to reform the tax regime. And one of the reasons why there's been a delay is because of the concern of the crisis of living, cost of living. And you remember, under those laws, there's been a removal of the support by government around the cost of fuel. In fact, it's even introducing a surcharge on fuel, a 5% surcharge on fuel. So as a result of those concerns and the removal of the subsidy, there was a move to delay the implementation. However, we expect that the guidelines and the subsidiary legislation to support that will come in this quarter 4. And so we'll be giving you an update as we go along. Next, we have seen DRC as well join the rest of the East Africa community in terms of electronic tax invoicing. We now have a specific requirement that all transactions must come through an electronic tax device. And we've seen that in Kenya through e-Teams. We've seen that in Uganda. We've seen that in Tanzania and Rwanda as well. So it's really no big surprise to see DRC coming through there. We've also seen a move to simplify direct taxation. And you'll recall that in Rwanda, in DRC, we have tax rates of up to 40%. So it's probably just trying to simplify that. Then further afield, we have seen Zambia introduce the minimum alternative tax effective 1st January 2025. That was an interesting one because the law came in August 2025, but it's effective 1st January 2025. And remember, in Zambia, we do have presumptive tax and also turnover tax. So this is now the third kind of tax, just to ensure that everybody is paying taxes. So that's an interesting one in Zambia, and we'll continue watching it. But a very important one that we have seen in the US is a proposal that is currently before the Senate. And this is what is called the Hire Act. And what this act is talking about, is proposing, is to introduce a 25% excise duty on entities that outsource. And HIRE actually is an acronym which means Halting International Relocation of Employment, HIRE, HIRE. And so it's basically saying if you're a US entity and you subcontract or you offshore your operations, then you are relocating employment and we're going to penalize you 25%. Why should Kenya care? We have a lot of outsourcing activities in Kenya, and therefore this is something that is likely to impact. And we've already seen some comments from especially IT companies and manufacturers, which were saying, this doesn't really portend well, because one other thing to note about this proposal is, in addition to the 25% excise tax, these entities in the US will not be allowed to take a deduction of that 25% cost. And so, and even the cost of hiring itself. So meaning that you'll be paying corporation tax on that. So we can see the US just really trying to protect its staff in terms of job creation. And so that's also a development that we are keenly watching. Allow me to now then invite my colleague Maggie to take us through the recent case law and developments. Maggie?
Thank you, Robert, for the tax updates from around the globe. Let's now delve into the recent developments on case law from the Tribunal and the High Court of Kenya and that of our neighbor Uganda in this quarter. Our first case is the Alliance One Tobacco Kenya Limited versus the Commissioner of Legal Service and Board Coordination. In this case, the critical question was whether intermediate and incomplete processes are deemed as manufacturing for the purposes of excise duty. The respondent in this case had assessed the Alliance One Tobacco activities as manufacturing and assessed tax in the amount of an outstanding 22 billion Kenya shillings in excise duty. On the other hand, the Alliance One Tobacco Kenya argued that its activities did not constitute manufacturing as it only procured raw tobacco from the farmers. It then shredded and stemmed the tobacco, repackaged it for transportation to licensed manufacturers who then processed the raw tobacco into consumable products such as cigarettes. The court relied on the definition of manufacturing under the excise duty and found that manufacturing includes intermediate and incomplete processes in the production of accessible goods, such as tobacco. And for that reason, the appellant's activities indeed fell under the definition of manufacturing and they were liable for the assessed excise duty. Our second case is the case of Harrier versus Commissioner for Domestic Taxes. In this case, Harrier had transferred his shares and self-assessed for capital gains tax at the prevailing rate of 5% in the year 2022. Thereafter, he had his share transfer agreement stamped in 2023 when there was a new capital gains rate of 15%. The question then arose in court that when is the correct tax point for the payment of capital gains tax upon a transfer of the tax, since the respondent had claimed that the rightful payment of the capital gains tax was 15% in 2023 when the share agreement was stamped. The court found, however, that transfer occurs when the property is one, transferred, exchanged, conveyed, or otherwise disposed. For this reason, the court held that transfer of shares and the correct capital gains tax point should be when the shares are legally and economically transferred. When the shares are legally and economically transferred upon sale and payment. For this reason, since Harrier had sold and gained payment for his shares in 2022, the right prevailing rate was 5%. Moving on to the third case is the case of Kerin Pipes Limited versus the Commissioner of Intelligence, Strategic Operations, Investigations, and Enforcement. In this case, the respondent had assessed the appellant's activities and using the banking analysis method, stated that all the income in the banking in the bank, all the bank deposits in the bank accounts of the appellant constituted its business income. However, the Kerin Pipes Limited stated that their deposits constituted other income such as loans, capital injections from its shareholders, and advance payments from its customers. For this reason, the tribunal in this case assessed the evidence put forth by Kerin and found that it did not produce substantial evidence, sufficient and verifiable documentation to prove that this is the position that indeed its income constituted loans, capital injections from its shareholders, and advance payments from its customers. For this reason, it upheld the respondent's decision to assess all the income in the bank account of the appellant to constitute its business income. Moving on to the fourth case, this is the case of Nairobi Bottlers Limited versus the Commissioner for Domestic Tax. In this case, Nairobi Bottlers Limited sought to rely on the tax exemptions under the Kenya-South Africa Double Taxation Agreement on the payment of withholding tax for payments for technical services and computer charges that it had made to Coca-Cola South Africa. The court, in deciding this case, applied the ownership test and found that Coca-Cola South Africa is owned by Coca-Cola USA at 67.5% and at 33.5% by the Goucher family investment. For this reason, since Coca-Cola USA owned more than 50% of ownership in Coca-Cola South Africa and is not a resident of South Africa, neither is it a person in the literal sense, it found that it failed the ownership test. The court held that for a taxpayer to be able to benefit from the tax exemption under any DTA, they should be able to prove that 50% of ownership is held by the resident individuals of the other contracting state. Last but not least, we look at a case from a High Court of Uganda. This is the Kampala versus the Uganda Revenue Authority. The Uganda Revenue Authority sought to impose VAT on membership and subscription fees of the appellant, stating that these fees are paid for the access to the facilities, to the club facilities of the appellant. However, the court differed with the respondent in this regard, stating that membership fees are paid for membership rights and privileges, and these do not constitute consideration for business activities. Since then, the appellant's activities were only for social and communal use and not for profit making. The court held that then VAT would not be imposable on the membership and subscription fees of the appellant. That being just but a few highlights from our case law in this quarter, I hand it back over to you, Robert.
Thank you very much for that, Maggie. And indeed, just to give you a flavor, there are about 391 cases stuck in the High Court, and that just tells you the kind of disputes that we are looking at. It's also good to see that the Uganda Revenue Authority has lost a case, which aligns with what Sigona, the case that Sigona won not too long ago. So we'll continue watching that space, even as we see some very, very precedent-defining decisions, including that agents are allowed to claim input VAT, and that's a position that overturns really the decision in the Dutch flour case, which has been a big problem for agents. So that's really a good one. Now, looking forward, what's the outturn? Now, the first thing to understand here is that Revenue Authority has got a very stretched target. Actually, internally, their target is about 2.9 trillion, and that is from 2.571 trillion that they had last year. And that tells you that you've got about 400 billion shillings in additional revenue, or about 15% growth. What that tells us is that they're going to be very aggressive. And actually, what we are hearing from the first quarter, which ended on Tuesday, that is 30 September 2025, that Revenue Authority missed its target by about 52 or so billion shillings. So that tells you that it's going to be a very aggressive Revenue Authority, and we've already started seeing that with the special table. Next, we've also seen a focus on administration and compliance. You've seen Revenue Authority going out. Actually, they're in the process of finalizing their ECLE office, probably to collect more taxes from that particular business community. And so we can continue seeing a focus on compliance, driving compliance. One other thing that we've recently learned is that the Kenya Revenue Authority is in the very advanced stages of setting up a data warehouse, which tells you that the Ushuru GPT and the data drive to analyze the data, big data really is a big issue for Revenue Authority, and therefore we'll continue watching that. And ladies and gentlemen, this is probably one of the reasons why that drive is so big. You see, this is yesterday's headline, which says that 3/4 of farms are not paying taxes, and Luke just told us about 14 or so million PINs which are not active. So you can clearly see where this is going. Then we have National Treasury at very advanced stages in terms of making the budget for 2026-2027. The sector working groups are already meeting. We expect this month Treasury to invite stakeholders and the public really to give their views around the 2026-2027 budget. We've also talked about the draft significant economic presence tax regulations, and those ones are already out for public participation. Yesterday I was at Revenue Authority. They are working on two other regulations, that is the Advanced Pricing Agreement regulations and the Qualifying Domestic Minimum Top-Up Tax QDMTT regulations. It's a bit complex, and we expect that those ones will be published in the current quarter for purposes of public participation. Overall, what do we look at? What should we be looking out for the quarter and the year ahead? First and very, very important is that Revenue Authority has communicated its intention to disallow expenses that are not supported by an e-Teams. And so that is a big issue for businesses, for taxpayers, and please ensure that all your expenses are supported by e-Teams. Essentially, what will happen is that when you file your 2026 tax return, any expense that is not linked to an e-Teams will be automatically disallowed, and in fact you will not even be able to claim it in your iTax. So that's something that we all should really look for and ensure that we're complying. As always, we'll continue watching the developments in the space and keep you updated. And that's all we had time for today, ladies and gentlemen. Very happy to take your questions, and back to you, Salame. Thank you.
All right. Thank you very much, Robert, Luke, and Maggie. That was a very informative session. We jump straight into our Q&A session, and I invite everyone to put your questions into the chat. But to start us off, Diana would like to know what the non-deposit taking law means to pay-as-you-go companies. Bob?
Indeed. This is something that we are actually looking at, Diana, and that's a very good question, because if you look at the broad reach of that regulation, it appears that CBK is going after anybody who does lending. But because pay-as-you-go is a form of financing transaction, in our view, we think that pay-as-you-go entities will need to either get approval from CBK in terms of registration or confirmation that that transaction is not captured. However, our initial reading of those draft regulations is that pay-as-you-go entities will be subject to control by the CBK, essentially because of the financing element in that transaction, because the CBK is looking at regulating anybody who offers financing transactions or financing support in the country. Salam?
Right. Thank you very much. Next question is from Gashao. What is the effective date of the reduction on the timeline for which one can claim input VAT?
Luke,
Bob,
you're
did
on
you
mute.
get me?
Yes, I got you. I was just seeing Luke on the call there. But just to answer that, first of all, this is a proposal. It's still a bill. The business laws, the business laws amendment bill, although it's really an omnibus bill which has got some tax provisions. So the whole idea is that it's not yet been introduced in Parliament, but the proposal is 2 months. And the driver behind that proposal is, since everybody who is VAT registered is on e-Teams, then automatically you should be able to claim your credit immediately the invoice is raised. So that really was the thinking. Of course, we disagree with it. I disagree with that reduction in timeline, because global best practice is 6 months. So I don't see a reason why we should reduce that timeline. But we'll be watching the effective date of that particular amendment. Rashao.
All right. Thank you. I don't know whether this one will be taken by Luke or by you, Bob, but Lucy Joan asks, when was the Ushuru GPT effected or introduced?
Okay, so allow me to just take that one, because I had the privilege of talking to the commissioner when he was telling us about that. So it's actually already operational within KRA. So if you go to KRA and you ask a KRA officer to give you a provision of the law, they quickly use Ushuru GPT. So it's already internally in use. The challenge that was there was, where do you house it for purposes of the data privacy? And so this is the reason why KRA is in the process of getting a data warehouse. They've actually just recently signed a lease for the data warehouse. So we expect that it will be secured and therefore be in use and probably available to the public in not too long. But currently, it's an internal tool for KRA.
All right, here's another one. You mentioned revenue targets, and Esther Diana asks, what was the revenue target for the first quarter? And to please expound on that, and by By how much have we missed it? And what would aggressive mobilization mean for businesses, especially SMEs?
Yeah, those are, thank you very much for those questions, Salame. Now, so we don't have the revenue target for the quarter per se. We just have the broad number that Revenue Authority is working towards, which is about, well, officially is 2.7 trillion, but internally they're working with about 2.9 trillion. The key thing is that they missed it by about 52 or so billion in the first quarter, and that has been building up. I think as of end of August, they had missed it by about 32 or so billion. So it's really been ramping up, which tells us that we're operating in a very, very tough economic environment. And just to paint the picture, we have about 4 million active taxpayers. And of those 4 million, 3 million are people who pay PAYE. These are people who are formally employed. Then the 1 or so million is made up of two big groups. One is 10,000 taxpayers within the large and medium taxpayers office, which is 10,000 taxpayers, and then 950,000 small taxpayers. That gives you the other million. So we are talking about 4 or so million people who are paying taxes. And that's the reason why you see KRA saying we want to look at big data. We want to have agents, 10,000 agents. Those are many agents, like the KCB Mtaani and all these other COP Jirani and those kind of things. So that's the whole idea, that KRA will come to Mashinani and be able to collect that tax. Why do I think they missed the target? I think it's just a tough economic and operating environment. We've not substantially grown the tax base. This is the reason why you can see some of these initiatives. Salami?
All right. Doris comments and says she's looking forward to the details on the Kenya-Belgium DTA. And then Carol would like to know, what documentation would employers need to prepare if they choose to take advantage of the gratuity exemption?
Yes, and for Doris, indeed, that's an interesting DTA. You remember there was public participation sometime in 2023, and so many of us actually forgot about that. So we're just waiting to see the final text. But just to note, typically when DTAs are signed, they become effective the following January. So now that this has been signed in October or in September 2025, we hope that it will become effective in January 2026, so that now the provisions come into play, and hopefully we'll avoid double taxation. Now, to Carol's question around the documentation, this is a very tricky thing, because one of the things that the commissioner did point out is, well, Robert, we think a lot of people are going to take advantage of this provision and not pay taxes. Because, for example, if my contract is coming to an end, even though I didn't have a gratuity provision in my contract, and my employer decides to pay me an ex gratia gratuity, then clearly it should be exempt, because I've only earned that gratuity post July 2025. And anyway, I was not even earning it contractually before. So I think one of the things that employers will probably need to do, and even employees, is review those contracts, just clearly determine when the gratuity becomes payable, even though you've been providing for it as an employer. Those are some of the things that we probably would recommend. But we know that there's going to be an amendment coming either in December or thereabouts, to clean up that gap that Luke talked about, because the gratuity is exempt, which was the design intention, but the law was not properly amended so that Section 5.2 still subjects gratuity and to tax. So that's a cleanup that we expect to come through. Salame?
All right. I think we have time for just one more question. Ida Simba would like to know, regarding the Nairobi Butlers Limited case, perhaps we could expound more on the ruling. She asks what withholding tax rate is correct for such a situation.
Yeah, so Ida, that's and probably we can take this on offline given the time. However, because Nairobi Butlers was paying a South African entity. So the issue was, first of all, is there withholding tax? And remember, we've had several decisions of the tribunal and even the High Court with regard to these DTAs in South Africa. We had the McKinsey case for South Africa. We had the Total for France, essentially saying that management fees is not subject to withholding tax in Kenya under the DTA. And so that was the debate here, whether the management fees is payable to South Africa is subject to withholding tax or not. If the DTA applied, then no withholding tax would have applied, and that was Nairobi Butler's argument. However, the KRA's argument was, wait a minute, we don't think this South Africa DTA applies because the owners of the South African entity are actually not South African residents. And so they cannot benefit from this treaty. That's what we call limitation of benefits clause under Section 41 of the Income Tax Act. So that was really the whole issue. And before we even decide what is the correct withholding tax rate, is it 10%, 20%? The issue was, does the benefit of a lower tax treaty even apply in this case? And the High Court, the tribunal was of the view that no, it actually doesn't apply. And so the full rate, 20% withholding tax, would apply on that payment. That was really the issue.
Okay. All right, ladies and gentlemen, that's all we had time for. But please interact with us further through our social media handles or reach out to any of our tax advisors through the emails on your screen. Thank you so much for joining us. I remind us that the link to the survey is still up. We would love to hear your thoughts. See you next quarter. Adieu.